Greetings everyone, Joseph James here with your nightly newsletter, brought to you by theschooloftrade.com. Today was August 17th, 2009. Before we talk about the trades we took today, guys, we're making our way through the third week now here in the month of August, trying to get our way into the fall, obviously. We're waiting patiently for that volume to come back here once we get past the Labor Day holiday here in the U.S. First week of September. I want to remind you guys we have a free resource online. Go to our YouTube page, youtube.com/School of Trade. And guys, when you're there, please take a moment to rate and comment on those videos. We're keeping you guys updated on what our totals are here for today. We didn't take any, well, we took one trade today, but it was a scratch trade. I'll show you guys that here in a little bit later. Nothing in, nothing out today, which brings, of course, being a Monday, our weekly total of 0, and our monthly total here in the month of August, a very slow month of August, at 1545. So just a 4-contract account. Let's talk about our term of the day. The term of the day is sentiment, or what we call market sentiment. Market sentiment is the overall opinion of the market by the mass majority of the participants in that specific market. So you'll hear me say something like the sentiment is bullish because we can see more buyers than sellers at this level of resistance, right? That may be one way to use this term, market sentiment. So it's the overall opinion. It's what people think the direction of the market should be based upon their actions in that market. Now, we use things like price action, candlestick patterns, momentum, and other different technical indicators will help define for us what the overall sentiment really is. Okay, so in the trade room, in our live trade room, we watch for certain things like price action. That is on our time and sales window. How does price react around support and resistance levels? We also use price action to ask, are the moves seeing follow through to the upside or to the downside? So when we do see a breakout, a move set up on our charts, are we seeing follow through? And of course, that follow-through confirms the direction of the sentiment. So if we're taking a long trade and we see lots of buyers jump onto that position, in other words, solidifying the move to the upside, the follow-through to the upside is further confirmation of the direction of sentiment. So by seeing follow-through to the upside, we assume that the sentiment is long. Follow-through to the downside would mean that sentiment would be short. And we also, don't forget, have a wonderful technical indicator available to our members. It's called the pace of the tape indicator. And of course, the pace of the tape is going to quantify the actual speed of the time and sales window for us. So by giving us a number or a quantity as far as the speed goes, it allows us to use that to make educated decisions about what the sentiment of the market is. In other words, if we see the pace of the tape indicator speeding up, right, as price is increasing, so price goes up, speed of the tape goes up, we know that the sentiment is up. Price goes up while the pace of the tape slows down, we know that the sentiment is probably not up, it's probably down. So we look to see that pace of the tape indicator to confirm the move with increasing price action to, of course, confirm once again the direction of the sentiment. Now we also use a technical indicator called momentum. This can be a stochastic or an RSI. Momentum indicators are very common. The momentum, if it's moving with price, will of course solidify the overall sentiment. If we see a divergence between momentum and price, that is, if momentum is pointed down and price is moving up, then that pretty much confirms that the sentiment is not the long side. Okay, so if we see a divergence between momentum and price, that means if price is rising while momentum is falling, that too is going to give us a better clue as far as the direction of sentiment in the market. And of course, don't forget about market profile. Market profile is a wonderful technical indicator that we use. Okay, it's going to give us ultimately a directional bias, which is generated by the value areas. So depending on what location of price is relative to the value area high or the value area low, that may also confirm or solidify what the direction of sentiment is. Right? We use market profile, the value area high and the value area low, to identify directional bias or the sentiment of the market compared to the value we saw yesterday. So as you can see, guys, we watch price action, momentum, market profile, and we have some technical indicators that give us a handle on the way as well. Now, of course, come join us tomorrow morning. Our live trade room opens up at 2:45 a.m. and we'll show you guys how we identify market sentiment. We'll show you some of the tools we use and kind of the techniques that we use. We'll give them away to you live in real time, absolutely free of charge. So come out and join us, guys. The beginner's course is highly recommended for all free trial members. So come join us. Lifetime members and trial members will trade the European session at 3 a.m. We'll trade the U.S. session about 8 o'clock, 7:45. We'll get started on the U.S. session. And we have 3 jobs: identify, adjust, and execute. Now we're trying to develop the trader's mentality here with these 3 jobs, and that is to identify the news events in the market we see, adjust to those events, and adjust to the market we see by marking up our support and resistance levels. And of course, we look to execute our trades with patience and discipline. Now, we want to remind you guys, job number 3 becomes very easy if we just simply stop thinking so much and let those rules do the trading. And we're going to show you guys what those entry rules look like live in real time as we watch trades set up. And if you guys were with us today, you saw a pretty boring market this morning. We had more volume than we saw last week, but at the same time, we still weren't there at the point where we were having enough volume and enough follow-through to actually see any of these trades really set up. We really took our time this morning. Once again, great experience as far as having to use patience and discipline, being required to really use our rules with the utmost of importance. So we really had to do a good job today as far as following our rules, just like we did last week. Very easy for us to get emotionally caught up in over trading here or creating trades in these low volume environments like we see in July and August. Not to worry though, guys, this will change dramatically come after Labor Day here in September. But here today, the only trade we took today was here at 9:40. This 9:40 a.m., a two-step long here on the crude. Fill here was at 47, and what I want you guys to see is this is actually an example that we used as what not to do here in the room. Now, this was a mental mistake that I made, and as you guys know, when it comes to making mistakes, right, we are all human beings, and we're going to make mistakes sometimes. If you make a mistake, there's two very important things that you want to do. The first thing is identify that you've made the mistake. Now you need to react to that by getting out of your trade as soon as possible. It's not just enough to say, oops, I made a mistake. We now need to have the confidence in our entries, the confidence in our rules, right? And of course, that confidence is done by consistently coming in and watching these trades all day long. And so by consistently doing that, you're going to know when you make a mistake, you're going to have the confidence, oops, I made a mistake, I know why I made a mistake, and now I got to get out of this trade. And that's exactly what we did on this trade here at 9:40. This two-step long at 47, this is a classic example of what happens to a lot of our traders, myself included sometimes, is that on a two-step, right, we're going to go in and we're going to mark up our swing high. Well, once we identify a swing high, and in this case, it was at 44. Our swing high, this blue line here, was marked at 44. Now, normally, we're going to simply wait for price to break above that swing high to get, in this case, to get long on this trade. But we had to make sure that we didn't have any overhead resistance. So when we mark up our swing high for a two-step long or a swing low for a two-step short, the first thing we need to do is identify, do we have anything above us, any overhead resistance that could potentially get in our way? What happened on this trade was at 9:40, I identified the overhead resistance at about 55. And as you guys know, we needed to have 6 ticks of room between 44 and the next level of resistance overhead. So 44 was our potential entry plus 6 ticks equals 50, which means resistance overhead at 55 shouldn't have been a concern. Well, here's where it became a concern. These overhead resistance levels in the form of our medium time frames, as you guys see live in our room every morning, well, these are what we call dynamic levels of resistance and support, which means they're always recalculating. They're always changing. And what happened on this particular trade was that by the time I was able to get into the trade, I simply didn't do my job as far as checking to make sure that that overhead resistance hadn't been recalculated down into closer to my position. So, of course, what happened is unknowingly, I got in above 44, got filled at 47, and quickly noticed that I had not paid close enough attention to that medium time frame. The medium time frame had gone from 55 now down to 48, which of course does not give me enough ticks, right? Does not give me 6 ticks of room to get that first profit target filled and eliminate all the risk on that trade. So what happened was I had to immediately get out of that trade early for a small scratch trade. What I want you guys to see on this trade though is the mistake that I made was not paying close enough attention to that medium time frame. And most importantly, when you see that mistake happen, get out of that trade early. Dynamic level of resistance overhead, that's what got in my way. And it's always recalculating. So make sure tomorrow, don't make the same mistake that I made this morning. Make sure you double check those medium time frames and those trigger lines as overhead resistance to make sure they're not recalculating and going to be less than 6 ticks of the room you need to take that trade. All right, so 9:40, our only trade this morning was a scratch trade. Let's recap. As you guys know, live trading opens at 2:45 a.m. Open up on Mondays at 7:30. Guys, it's a free webinar on Tuesdays and Thursdays, 11:30, so make sure to come out and join us. We'll give you live trade calls, plenty of opportunities, guys, for questions and answers. We'll give you free 3 weeks as part of our trial. I want to remind you guys the beginner's course is highly recommended for all free trial members. And guys, please take a moment to rate and comment on those YouTube videos. If you want more information about our lifetime membership, please email us, sales@schooloftrade.com. My name is Joseph James. Hope the video helped. We'll see you guys tomorrow morning in the trade room, 2:45 a.m. We'll see you then.